we'll come back to default. Today, I'm going to share a story about how a Raydium launch strategy absolutely blew up my portfolio. Let's dive into the risky world of DeFi and project launches, remembering this is just my experience, not financial advice. E's strategy revolved around farming for allocations, specifically, farming Raydium tokens, or Ray, and LP tokens to qualify for initial DX offering, or IDO, allocations. The perceived benefit was a guaranteed allocation at a discounted price compared to the open market after launch. This involved specific farms, like RayUSDC or other token Ray pairings, and it was appealing because it offered a seemingly lower entry barrier than buying tokens outright later. The project I chose was, insert project name here. It seemed promising, with a compelling value proposition, generating considerable hype, and boasted endorsements from a promising team. Looking back, however, there were definitely some red flags that I ignored in my excitement. Remaining isn't free. There are implicit costs involved. Impermanent loss, or IL, can take a bite. This is when the value of your deposited tokens diverge from simply holding them, leading to potential loss. For example, if one token in your LP pair rises significantly in value compared to the other, you could end up with fewer of the rising token. Then there's opportunity cost. While your funds were locked in these farms, other potentially profitable strategies were missed. And let's not forget gas fees. The transaction costs for depositing, withdrawing, and claiming rewards can add up significantly. Finally, there are always staking risks, such as smart contract bugs and vulnerabilities that could compromise your funds. Launch day, the experience was quite disappointing. Instead of the anticipated gains, the token experienced an immediate and sustained price decline. Optional, I could even show you a screenshot of the chart, but trust me, it wasn't pretty. The reasons behind the dump seemed to be a combination of factors: the project being overhyped, weak fundamentals, possible whale manipulation, and poor tokenomics that incentivized early selling. Quantifying the losses was painful. I experienced losses from impermanent loss in the farms, plus significant losses from the failing token itself. And when you consider the opportunity cost of what else I could have been doing with those funds, the total percentage loss on my portfolio was substantial, a real hit. Lessons learned. Due diligence is paramount. Thoroughly research the project, the team behind it, and the tokenomics before diving in. Diversification is also key. Don't put all your eggs in one basket, especially with high-risk launches. Manage risk with stop-loss orders, if applicable, to limit potential losses. Be wary of hype. Don't FOMO into projects based solely on social media sentiment. Understand tokenomics, scrutinize the distribution, vesting schedules, and supply mechanisms of the token. And finally, consider stablecoin pairs or other strategies to mitigate impermanent loss. The cautionary tale of this Raydium launch strategy highlights the importance of continuous learning and adaptation in DeFi. I encourage you to share your own experiences in the comments below. And remember, this is not financial advice. Always do your own research, or DYR. Thanks for watching. See you next time on Default.